No, it's good to be back. I don't remember when I was here last, but have I been down here this year? I haven't been here this year, have I?
No.
Must have been last fall sometime. So, well, a few things have changed, a few things haven't changed. A few things will change while we're talking this morning. That's the way it's been here lately. Lots of volatility, that's the headline here. Obviously, across the board in every respect, we're dealing with lots of uncertainty and volatility, even more than we had before, and we had plenty before. But, in general, again, we're going to go through all this. Cattle numbers are declining. Demand has been good, but there are some question marks, maybe more so now than even before. Drought. We'll talk about drought and whether we did much with that a little bit last night. I don't know yet. It's a little early to tell. And, probably the biggest thing that is kind of the topic of conversation across the board in agriculture and in lots of other ways is input prices. And so lots of issues there. I don't necessarily have any solutions, but we'll talk about it anyway. It's kind of like the weather. I can't do nothing about it, but we'll talk about it because that's what everybody wants to do. So, I pulled a couple of charts early this morning just to kind of show you, this is corn, this is May corn futures. And so you can see where let's see here. You can see where the war in Iraq and the Ukraine started. And so this thing jumped up. It has pulled back just a little bit, although, the May with the nearby ones, not as much on this. I didn't pull wheat. I didn't pull a wheat futures chart. It's been even more dramatic, but it's also pulled back a little bit more, I think. I haven't followed it as close. But obviously, so you had that big immediate reaction. The Ukraine and Russia are both major exporters of wheat and corn, as well as sunflower oil and oil in general and other things. And so, that's probably been, and from a cattle perspective, it's the feed markets. There hasn't been a great deal of direct impact in cattle and beef markets, okay? Russia's like the number 10 beef importing country, and they're 3% of the total or something. So they're a pretty minor player, and they don't export anything. We haven't exported any beef to Russia since 2012, I think it was, and we haven't exported any pork or poultry since 2014. So there are no direct impacts there, and really no impact in terms of meat flows in a global market sense. But because of what happened in the feed markets and oil markets and other things, this is the March feeder cattle futures, and I realize we're almost done with that. But I thought I'd show this one. So again, you can really see over there where I can't use my laser pointer. I have to go back to old technology here. Then I have to remember not to hit the screen because it'll do things. Daggum touch screens do stuff when you touch them, whether you wanted them to or not. So you can see what happened. We jumped down, and we have recovered a little bit recently from that. We'll look at cash prices here in just a minute. They also were impacted because of this. So we're still dealing with that. It's starting to settle into a little bit past the initial shock. But obviously it's an ongoing thing and very uncertain. And this is something we haven't had to deal with in a long, long time. In that, this is not a weather event. It's not a, sort of a normal market or economic event. This is purely political / military. There's no way to predict where it goes, when it goes, how far it goes, whatever. So it makes it really a challenge, and that's going to be there. Calf prices, again, you can see the drop there. They have bounced back a little bit. I've been spending quite a bit of time in auctions collecting data, and you can see that. Last week, cash prices picked back up a little bit from the 2 weeks prior to that. And I think they're a little stronger even this week. I'm going to leave here today and go to El Reno and collect a little more data. I've been spending way too much time in auctions here lately for me, given that I don't actually buy or sell anything. But we've been doing a big project with AMS, so we've been collecting a lot of data. So you can see that it did drop, but it's bounced back a little bit now. Was the February peak the spring peak? I don't know. It could have been, or, do we have a chance to run back up there and actually take out a peak? We'd have to do it pretty quick from a spring standpoint. I sort of doubt it, but we might. But that said, when we get to the price forecast, probably the highest prices for the year for all of this stuff is going to be in the last part of the year anyway. Okay, so we'll talk about that. But in terms of the near-term stuff, big feeder cattle, same thing. You know, again, we did come down. We've bounced back just a little bit from that. Fed cattle have sagged a little bit. They're just kind of holding steady. You know, again, that February peak was probably the spring peak there. But it's possible we could make another run up here in the next 2 to 3, 4 weeks from a spring standpoint. And then we'll probably see some seasonal pressure into the summer. But again, the uptrend may wipe all that out as we go forward. And that's kind of what happened last year. I mean, we were pretty flat through much of the year, grinding our way slowly higher until the end of the year. And then we popped up finally in November. And that's where we are now, kind of operating at that level. Box beef cutout was really strong last year, and, you know, kind of bumpy, but, you know, very strong. And if you look behind it, I've got a bunch of cut prices if we have time and interest to look at them a little bit. And we, you know, again, we came down a little bit from a late January thing, but it's turned around now and actually trying to rebuild. We should be moving in here in the next 2 or 3 weeks into some, you know, pre-grilling season buying, because that'll happen a month ahead of time. And so by the time we get into April, we'll start seeing some of that. And it looks like that's still holding together pretty well. So again, we can talk a little bit more about that perhaps. Cull cow market has been phenomenal. Anybody sold any cull cows? Bought any cull cows? Just incredible. And, you know, a very, very strong hamburger market behind this. The boneless market has been extremely strong. And so, you know, and last year, actually, compared to the year before, cull cow prices stayed remarkably strong. Cull cow slaughter, beef cow slaughter was up 9% year over year last year, enhanced by the drought. And yet, despite that, the prices actually stayed pretty good.
What's driving that?
Hamburger market is incredibly strong. Okay, I can show you those charts here after a bit. If we get, I put them at the end, we'll see where we have time for. But yeah, again, it's part of overall stronger beef demand, but it may also be, and this is part of what I'm watching going forward. I think it's more coming rather than here. You know, we've been hearing a lot of talk about how high beef prices were and consumer pushback. And did you guys see that the other day? Some barbecue guy in Kansas City was telling people to quit buying brisket because it's too expensive. And he didn't say that he was having trouble selling it. He just didn't want to mark it up. And I don't get that. You know, if people are willing to pay it, mark the damn stuff up and sell it to them, you know. I don't understand what his problem is. But he was basically saying, you know, we can make these prices come down if you'd all quit buying brisket for a couple of weeks. And I'm going, what the hell would you do that for? But anyway, I don't know.
Everybody else quit buying it. So they can keep it
well, you know, I don't know. Yeah, maybe that's one of those deals. I'm not sure. But anyway, so yeah, the cull cow market. So if you look at this chart, shows from the November low, or what's typically the low in November, to January, February, March, April, and May, how much the cull cow prices seasonally typically increase. And so if you look at November to February this year, that dark blue bar, you know, that says 40%. That's a Southern Plains kind of average. I think that Oklahoma price series, if you look at it, we're up like 60% over November. Okay, it's just been phenomenal. It normally goes up about 15% between November and February. It'll go up to about 20 to 22% in March. We're running well ahead of that at this point. So that market's been really strong. And again, as we go forward, one of the questions about beef demand is whether or not consumers start trading down. We talk about that when steaks get too high, people will cut back a little bit on that. They don't quit eating beef typically, but they will do some trading down. And, you know, we sort of watch that. It could show up in the ground beef market, but that market is just already really strong. And that's one of the things people are griping about is how high ground beef is, relatively speaking. So anyway, we'll watch all that going forward. I don't think any of that's really in there yet, but it could happen. Depends on how long and how much gas prices stay up. I mean, that's kind of the thing we look at. High gas prices affect you guys in terms of production cost and all that, but it takes dollars out of consumer wallets immediately, and that can be a pretty quick impact on beef demand, food demand, meat demand in general. Again, we'll try to get to those charts. This was last week's Drought Monitor. So this was actually as of a week ago today. This thing cuts off on Tuesday morning. And sometimes that's really important, like this week it will be. Actually, I'm glad that we got the rain yesterday and last night, because all of that rain should show up then in this week's monitor. I hate it when we get rains on Tuesday and Wednesday, because it's a week and a half later before you really see it in the charts. And so it really should show up. This is what it looked like. As of last week, nationwide, here you can see it. This plots those colors across time. Drought conditions last week were as bad as they've been since 2012. Okay. And there's a way to put all that together. They actually calculate an index from all of the categories of different levels of drought. And so it gives you one number, and that number was as high as it's been since 2012 as of last week. Okay, now we'll probably pull it back down at least temporarily a little bit this week because of what's happened right here for us. But going forward, we still got a lot of drought issues nationwide. And if you look at where that drought is and where beef cows are in this country, well over 50% of the beef cows are in drought affected areas. So it could get really serious. 2011, you remember, in Oklahoma and Texas, we were forced to get rid of 1 million beef cows in one summer. But that drought, it was extremely severe, but it was pretty much located just right here on top of us. This thing's much more widespread. And if it continues to stay widespread, and it won't stay the same, it'll either get worse or better. That's the nature of droughts, especially in the springtime, right? It's not going to stay where it's at, more than likely. It's either going to get better or worse. So we still got to keep an eye on it, even though we may get a little bit of help here, at least for a time being. The seasonal outlook is not very good. We have a firmly entrenched La Nina weather pattern, which basically says where the drought is now is going to stay there, and it may even get a little bit worse in some areas. This has got it expanding a little bit south and east of us across Louisiana, parts of Arkansas, East Texas, and so on. This goes to the end of June at this point. Now, these things are not super reliable. I mean, it's a guess, and these are climate kinds of things. So I wouldn't, you don't want to bet everything on these, but on the other hand, it's a place to start in terms of what could happen. That'll be a critical time period between now and the end of June in terms of what might happen to the cattle industry. Oklahoma, this was last week again, 57% of the state in D3 or D4, 92% of the state in some level of drought or dry. And this is what happened yesterday and last night. We may get just a little bit more today. I don't think we're going to get much. So I assume this was good news for you guys. It's gonna help some wheat. Of course, the cattle are gone except for grazed out wheat. There is a few grazed out cattle. I don't see a lot, but the wheat guys may actually now think about whether they can get in on some of this wheat market stuff. I don't know. Anyway, we'll see what happens. It's good. It's nice. It won't solve all our problems, but you got to start somewhere. If this is the start, that's great. We'll see what happens from here. Okay, back to the numbers. January 1, all cattle and calves down 2%, beef cows down 2.3%. That was a little bigger than most of us thought it was, although with the drought, we knew there was some additional liquidation. We didn't know how much. That would have probably come in at 2 or less without the drought. So we're down to 30.1 million beef cows. If you go back to 2019, which is actually the peak, so those 4 years represents the liquidation we've had thus far, and the beef cow herd is down right at 5%, 4.9%. So we've already had a fair amount of liquidation. And again, that sets up what could happen to us this year, given the way we're starting springtime. Beef replacement heifers were down 3.3%. Feeder supply down 2.6%. Cattle on feed was about the same as a year ago. Feedlots have been really good at making fewer cattle into more feedlot inventories. And they continue to do that. And they're going to be able to do it for another month or two. Sooner or later, I'm going to be right and they can't keep doing it. I've been thinking for 4 or 5 months they couldn't keep doing it. But you can borrow against the future for quite a long time. And then eventually it will catch up with you. And that's basically what they've been doing. Calf crop last year was down 1.2%. So that just puts a picture on it. You can see kind of the cycle from the low in 2014, the peak in 2019, and then here we are as of 2022. Beef replacement heifers again. So, you know, they were down 3.3%. That's the smallest level since 13, 14? I've run the numbers every way I can. And if we took out all the drought and we higher prices, and if that translated into a desire to expand or stop liquidating and maybe think about expanding, the best I can come up with is that we might be able to hold the cow herd steady this year. In fact, I think that's even pretty unlikely. I think we would, under the best of circumstances, probably still see 1/4 or 0.5% liquidation this year. We just don't have enough heifers. Unless you get really extreme. I play with the numbers. You'd have to take them way outside of any range that I think is sort of doable. And of course, with higher input costs, cattle prices will be higher. That doesn't necessarily mean profitability is going to be a guarantee with the input cost. And so that's another question of whether or not we actually would be trying to sort of turn this cycle around, even if we could, on the basis of the drought. Those are both questions, I think. Feeder supplies, again, dropped this last year. They actually went up a little bit last year. That was drought-related changes in timing. And then they did drop back off this year. And again, the numbers are getting tighter. I don't know if I have a placement chart in here, or at least up front. But I'll show you feedlot inventories and we'll talk about how they are doing what they're doing. Oklahoma's numbers were pretty similar to the national numbers. Our beef cow herd wasn't down as much, 1.3%. Our replacement heifers were even. Feeder supply was down 2.3%. Calf crop was down 1.5%. Pretty similar to the national numbers in this particular case. Cattle on feed is actually a little bit above a year ago, and it may even be a little bit higher on a year-over-year basis as of Friday's report coming up. Feedlots for several months now have been placing almost entirely lightweight cattle. If you look at the placements of cattle under 700 pounds for the last 5 months, they're up. It's 4.7%. Placements of cattle over 800 pounds were down 0.5%. So feedlots like to keep the pens full and the feed mill running. Okay. And even though lightweight cattle are not necessarily what they'd like to feed, when that's all there is, they will feed them. In fact, a feedlot manager told me 40 years ago, the only thing a feedlot hates worse than an empty pen or worse than a damn calf is an empty pen. And so, and that's basically what they've been doing. And of course, dry conditions, lousy wheat pasture has helped that. Cattle moved off early. They've been sucking them right up and so on. And again, you can do that for a while, but you can't do it indefinitely. I think it will catch up with them. It's taken longer, as it always seems to, than I thought it would. And the drought from here on might change that a little bit. We might be able to sort of defy gravity a little while longer if the drought continues to push cattle to market. But nevertheless, the numbers are getting tighter. Think about the other scenario. If drought is not in the picture and we did, as an industry, decide we wanted to stop liquidation and either rebuild or set the stage for rebuilding next year with the cow herd, that means we're going to save a bunch of heifers. That feeder supply number is going to get real tight real fast when that happens. So at some point it will happen. I'm not sure that it happens this year. In fact, I sort of doubt if it happens this year. But at some point in time, that's part of the reason our cycle tends to be pretty exaggerated. Is when we don't have enough, the only way we can get more is to make the tight supply even tighter to save enough heifers to rebuild for the future. And by the same token, when we have too many, the only way to get smaller is to market more heifers and cull cows and eat your way into smaller numbers. And so that's part of the reason we tend to persist with a cycle. You'd think if we know it's going to happen, we could avoid it. But because of the biology of things and so on, we really can't avoid it. So this thing, you know, I've been saying for a year that feedlot numbers would fall below year earlier levels and stay there, and they haven't yet, but I still think they will. We'll see. There's your markets. I put wheat on here. I'm not sure it's really a big factor right now. If you have wheat, it might be, but from a cattle market perspective, but that's what's happened to cash prices in the last few weeks and, you know, through last year. There's the corn market. Same thing. Now, we had that big run up last year in corn prices when we thought we were going to run short of corn for last marketing year. So that April, May run up last year, and then we decided we probably had enough. So we sort of worked it lower into harvest. But, you know, we're still at pretty lofty levels, and we're going to be at pretty lofty levels anyway. And now you throw this latest stuff in Europe on top of that, and it suggests we're going to stay there. This is updated annual numbers, so kind of the balance sheet stuff. 2021 crop year would be where we're at right now. So we're talking about national average corn prices pushing $6 and staying there for the next crop year at this point. And that assumes we're going to make a pretty good crop. I didn't put all the charts in here, but that's assuming last year's crop was the second biggest corn crop ever. We didn't have a lack of corn. We just had remarkably strong demand for corn. We exported a bunch last year. This time on a global basis, there just won't be as much corn available because they're already not shipping out of the Black Sea and doesn't look like they will anytime soon. And if we go just a few more weeks into Ukraine, they aren't going to get to plant, or they're going to be severely reduced. And so then it's at least a full crop year impact, regardless of what happens. You know, they're northern hemisphere. Ukraine is roughly southern Canada in latitude. So they're going to be, you know, about the US-Canadian border level, roughly. I don't know. I haven't pulled that for a while, but something like that. But it's a major grain producing area.
Derrell, do you anticipate the gas situation and ethanol? Are the ethanol people going to be buying a bunch more because of gas situation up front?
Well, obviously with higher gas prices, I mean, the ethanol thing just works better economically for them. And so that part will be there. I mean, part of what you're asking is sort of policy and political. And if they had their way, we'd all be driving the E15 year round all the time. And then they would buy even more. And I don't know that they'll get that done. I sort of doubt it. But the short answer is yes. I mean, you know, ethanol is working at these gas prices and these oil prices. So that'll, yeah, they'll pull a little more. I didn't pull those charts. I've got them on the industrial use. I glanced at them, but I didn't pull all of those charts in here. That's what happened to feedlot cost of gain last year as corn prices went up. So from January to September, pretty steady increase. We ended the year kind of flat at about 130, well, it was about 110 or so. The January number over there on the left side, this is feedlot closeout. So that's what they've been feeding for the previous 5 or 6 months, right? I mean, this is what they report as the cost of gain for cattle are selling now, which means they've been on feed for 5 or 6 months. That's 113. I'm going to show you some feeder price charts using that number. You know, if you take the futures market for corn and put a Southern Plains basis on it, it's not very hard to get close to $8 corn. And when you do that, then that cost of gain goes up closer to 125 in that situation. So we may not be done with that yet. Okay. The red line, excuse me, the blue line was last November. This is probably about what we talked about last time I was here. I don't remember exactly when that was. That was the feeder prices, Oklahoma auction average prices from lightweights to big feeder cattle. And you saw what happened there. And, you know, you have that flat spot, which that's normally a seasonal thing. You know, the fact that that line gets pretty flat from about 600 pounds up to 850 pounds is pretty typical, but it was exaggerated a little bit. And I'm pretty sure I said this then because of the higher feed cost. Okay, high feed costs basically makes feedlots generally like lightweight cattle less because they got to feed them longer. They got a bigger feed bill. Okay, and I just told you they've been placing lightweight cattle. That's what they do when they have to, not because they want to necessarily. But you can see what's happened since then. So the red line was last week's average price. Calf prices are up sharply. The feeder cattle had stayed pretty steady until very recently, and they're actually a little below where we were. But really up until about 2 weeks ago, that from 700 pounds up, the feeder price hadn't changed very much at all from last fall. The calf prices have gone up pretty consistently. So what does that do to your value of gain? When that line gets steeper, does that make your value of gain look better or worse?
Worse.
Much worse, doesn't it, Jerry?
Yeah.
Okay, and you guys know, I've showed you this for years. You know, I use this at a current point in time to sort of tell you what the underlying market signals are. Now, obviously, you know, if you think about buying on the left side and selling on the right side, you don't do that in the same market. You got to do it over a period of time. So at some point that becomes important. Right now, it's much more important than usual. Because if you take that, if you look at yeah, I was going to show you. So what's going on here right now? So the March futures, I pulled this screenshot this morning. Don't look at the time. I wasn't sleeping as usual. So anyway, March 155.80 yesterday. And this goes down. Now you can't really see. The October one was 183, I believe. And actually it peaks in November is about 184. So even from March to May, you got a $10 increase, and then to August, you've got another, what, 15 on top of that, 14? That's pretty unusual to have that much stuff priced into the futures market in advance, okay? And so I'll show you, if you go back to that November price line, this would have been what we were looking at last fall. And so, you know, cost of gain in feedlots had gone up. And if you look at, say, a 500-pound calf, 250 pounds of gain is that yellow box there, 112. Okay, so $1.12 was the gross margin value of gain at that point in time. And that roughly mimics what was going on with cost of gain. And that's what I would expect to happen. That's what I would tell you is going to happen. That cost of gain should be the mirror image of the feedlot cost of gain. If you calculate that table for last week, based on the current market, your 500-pound calf, 250 or 300 pounds of gain is worth 70 cents a pound. You can't put weight on for 70 cents a pound, I don't think. You sure won't make any money if you do, right? So that don't work. That kind of tells you where that current market is. In order for this to make any sense at all, you got to go out and use those futures prices. Okay, so if you think, I did an example in my newsletter kind of quickly. If you take that 500-pound calf and think about going to 800 pounds by, say, August, and you use that August feeder futures, you can take this 73-cent cost of gain up to about 140 using that August futures price. Now, it's obviously only a guarantee if you actually take a position in that August futures market. So we got a lot of stuff built into the futures that's not there today in the cash markets. That's sort of the point. And I don't know that I can ever remember a time when it was like this. I've been looking at this for a while going, what the hell? I mean, I sort of get it. You know, another way to interpret that right now is that the feedlots are buying those lightweight calves away from the stocker guys. Because they're telling you, we don't have enough cattle, we want to get them in the feedlot. Even though the cost of gain is high, to keep numbers up, they're putting them in the feedlot and basically pricing them away from the stocker guys. But if you look at the futures market, you reverse some of that. And you say, well, okay, the stocker margin's still there. You just got to go out and and lock it in with that future stuff. That's pretty unusual to have that much difference between the current cash situation and what's built into the futures. Like I said, I can't remember a time when that's really happened. If you take, and this is anchored on 825 pounds. So take the current cash price for 825 pound steers and calculate what a feedlot should be willing to trade off lighter weight cattle for. In other words, what's it worth to them if they've got to spend $1.13 cost of gain to put weight on them? That blue line tells you what they should be willing to pay for a 500 down to a 575 pound calf. The market's above that. Part of that's springtime. It always happens in the spring because there is grass demand generally, and it may get a little stronger with this rain. So part of it's seasonal, but part of it is the fact that the market's higher than that because cattle are getting in tighter supplies. And they're getting tighter the quickest on the lightweight cattle. Okay, so that's some of what's going on. Okay, switching gears a little bit. Cattle slaughter last year was up 3.2%. It was the peak. Again, that was carrying over some cattle from 2020 because of the pandemic. It wouldn't have been the peak last year, I don't think. Beef production was also a peak last year, as we will see. So far this year, the very right-hand column, steer and heifer slaughter total is down 0.5%. Steers are down more, heifers are still up a little bit. And if you look at dairy cows plus beef cows, the total cow slaughter is up 6.2%. Beef cow slaughter for the first 8 weeks of this year were up 16%. Now, how much of that's drought related? I can't answer that. Some of these guys may have gotten to this point in the winter and said, you know, I'm still awfully tight on feed. Drought conditions look pretty tough. I think I'm going to have to sell some cows. And what I think might be going on is I looked at that cull cow market and said, geez, I better go ahead and sell them while I can. So I kind of think that might be what's going on. I'm not 100% sure. I doubt that we'll continue to cull beef cows at that rate. If we do, then we're going to really see the numbers drop this year. I don't even know what that translates into on an annual basis, but it's a pretty big herd liquidation. So in total, slaughter is still up 1%, but most of that's in the cull market. It's not in the yearling market for the most part. So slaughter, I didn't talk about carcass weights. They're just they're actually a little above probably where they should be seasonally, but they are starting to work their way a little lower. You'd think high grain prices would help keep that in check too. It hasn't done it as much maybe as I would have thought, but it will kind of. So beef production in the green for this year, 27.1 billion pounds would be down 2.8% from a year ago. Last year was the all-time record beef production of just under 28 billion pounds of beef. Pork production is expected to be down about 1.5%. Broiler production up about 1.1%. We had that up closer to 3% until all the avian influenza stuff happened. And we won't be producing as many chickens. I heard yesterday, you might have heard this, that a commercial egg laying operation in, I think it was Iowa, was diagnosed this week. They will be depopulating 5 million laying hens by tomorrow, probably. They do it fast. And so it's hit commercial flocks, it's hit some backyard flocks, it's in wild birds, and it's in what, at least a dozen or 15 states now. They found high path avian influenza. So that's that. We haven't talked a lot about that, but that's another one of those things that's there that it is a factor, even though we're not really talking about it a great deal. There's the price forecast for this year. So from 2020 low, we were higher last year. We expect to be higher this year and next year at this point. And I don't really see anything changing that. The prices are going to be there. The revenue side looks better. Now, again, costs are a real issue, so profitability is a little bit of a question, depending on how that goes for you. But the prices will be there. And if you look at, there's all those numbers. So you know, third and fourth quarters of the year, I mean, we're higher right now significantly than we were this time last year. So for the whole year, 2022, the yellow area, we've got prices up, you know, 12-ish% on an annual basis. And in most cases, we very probably will put in the high for the year in the last part of the year with the trend up. Maybe not in every case, but it's certainly possible. This thing is trending up to sort of offset some of that normal seasonal stuff. And even next year, we've got, you know, prices up 5 to 10% at this point for next year. Now, these do get updated regularly, so they can change. They will change, I guarantee it. But that's kind of the way it looks right now. Just a little bit on trade, and then we'll see what questions you've got. I've got some other stuff I can show you if we have time and interest. Exports last year were record. 2021 beat out 2018, which is on the left-hand side for the previous record in terms of volume. It was also a record in terms of value. And if you look at those, the big change you see is the yellow chunk of that bar is China, Hong Kong. It was up almost 100%. It nearly doubled last year from the year before, 96%, I think. That's where the growth has been. You know, Mexico was up slightly. South Korea also is still growing and has been one of our more consistently growing markets in recent years. Japan was pretty flat last year. South Korea is only a little bit behind Japan as a share, and China is closing the gap rapidly on both of them. Now, China will probably slow down a little bit this year, but I think it will continue to grow. Although, again, with bigger uncertainty brackets around that now than even a month ago, just because of everything that's going on, and we don't know how all this is going to play out. There's what's happened in China, Hong Kong. So if you add China, Hong Kong together, Hong Kong was a major market for a decade, but as China came online officially, we expected Hong Kong to go down, and it has, because what was going into Hong Kong before and winding up in China unofficially is now going officially into China. And so, but the sum of the two together is really the total market that we're looking at. And you can see how that's really grown in the last year to 15 or 18 months. On the import side, imports were just about flat last year, almost unchanged. January's number was way up on a monthly basis, and it was almost all imports from Brazil. Not 100% sure what's going on there. I don't think that'll persist. I think that's because, if you'll remember, last year, China shut off Brazil for a little while, and then they got back, and there's some other European issues. So I think Brazil had a lot of beef, and our ground beef market is extremely strong. And so there was an attraction there. So we did see Brazil jump up, and it's been growing a little bit. Well, actually quite a bit in percentage terms last year. I don't think that will persist necessarily. And we turn that off. My family may start some wild set of text messages here that it's really annoying. So anyway, that's sort of where we are. Again, that import market is largely driven by the ground beef market. That's the bulk of it, and that's really strong right now. There's that. Let me stop for a second and see if you've got questions or comments you want to do too. And then I've got two things in here that we can do. I've got some stuff on the meat side of things, meat prices and so on, that we can walk through. And then I've also got some other kind of longer term structure stuff on the feedlot side that I've been looking at. There's a couple of those charts you might be interested in terms of, again, how the feedlot industry continues to evolve. Well, you can show you the numbers if you want. Questions right now?
Keep it moving.
Keep it moving. Okay. Well, I'm not worried about you guys. I know you'll stop me if you have questions. So let's talk about it. I said meat demand. This is really just prices, which is part of demand. But would you look at the other meats a little bit? So ham prices below a year ago. You know, they kind of jumped up here recently a bit, but they're still below a year ago. Loin prices. Through the last couple of years, loin's been one of the best buys out there. Okay, pork loin has been a pretty consistent bargain. relative to other meats most of the time. It did shoot up, but it's come right back down. I don't know what that was all about. But if you look at it relative to other meats and so on, it just hasn't, you know, and it stayed pretty attractively priced through much of this. Pork bellies, of course, we put bacon on everything. So bacon market's been strong. It's pretty wild at times, but it pretty consistently strong. This has been one of the bigger surprises in this. For the first time in a bunch of years, the chicken breast market has come to life. And I've talked to a couple of, well, at least one restaurant guy, and we were talking about all kinds of things. He said, I'm not worried about beef. I can handle that. He said, I don't know what to do with the chicken stuff. And I showed him this chart and showed him some other things. He said, all right, that tears it. I'm going to have to quit fighting it and raise my price. He's sort of been holding off since about November or December. And he said, okay, I got to do it. So that's chicken breast prices. Look at chicken wing prices. Now, much of the time over the last several years, wing prices have been higher than breast meat prices, which is just really interesting. If you think back 30 years, we used to basically throw the damn wings away. We sent them all to pet food. They've been the most expensive thing out there for several years, and they've actually been pretty flat. We didn't have any Super Bowl kick in the wing market this year, and it's actually dropped since then. And so at the current prices, I don't know what that is, $225 about. Breast meat is at $275. That's the first time in recent months. It's the first time in a long time that breast meat has been above wing prices. We had the chicken sandwich wars last year, all the fast food places. That's kind of what started it, but I'm honestly not completely sure why it's so dang strong right now. But it's very strong, which is another reason why I'm not terribly worried about pressure on beef prices, right? Because when these things are high, then relative prices are what consumers are going to look at, and that's going to take some of the pressure off of beef prices. Leg quarters, whatever that means. I mean, it's there. We use some of them now in the U.S., but we export a lot of them still. So on. Okay, I pulled more stuff in here because some of these beef markets are really fascinating on an individual basis. So chuck, top blade, this is where you make flat iron steaks. That thing took off last year, stayed really high, and then has come back down. And you're going to ask me to explain some of these, and I can't. I don't know what's going on, except that I know as food service has opened up and restaurants have come back online, there's a lot of jockeying in some of these wholesale markets. And some of it's related to exports too. We had record level exports last year, and those export markets are typically in certain products or heavily in certain markets. And that has a big impact on some things. Chuck roll. So that's the other part of the chuck. The top blade comes off the clod, and then the chuck roll is the other part. This is a big export market. And so that spike last year probably was related to exports. Chuck flap kind of looks like the top blade market. Brisket market was just phenomenal last year. And it has come down a little bit, although it's already started back up. Again, will be, well, grilling season doesn't impact that as much because not as many people actually grill that at home. It's a restaurant item predominantly. At least in our part of the world it is. In the Northeast, it's a corned beef thing, but we're past St. Patrick's Day now, so some of that goes away. Short plate, short ribs, big export item. So you see the increase last year, they plateaued, but at a very high level. $7 a pound for short ribs, wholesale. That's exports. That's the value of exports. Bottom round, top sirloin butt. So this is a kind of your value steak in a lot of restaurants, but that market was awfully strong much of last year. Tri-tip, not as popular in our part of the world than much of the rest of the country. This is kind of like brisket in the Northwest and the Northeast, and even in the Southeast now. It's gotten more popular. Big spike up last year. And again, we're running at $6 a pound compared to, you know, the 5-year average in the green line there was most of the time less than $4.50 a pound. Bottom sirloin, loin strip. So this is your strip steaks. This thing follows a very predictable pattern, and this is the only cut that followed a seasonal pattern through the pandemic. It really didn't change through the whole thing. It goes up in the next month or 6 weeks because of this is probably the most popular grocery store steak for grilling items. It is popular in restaurants too, but the seasonality is all driven by retail markets. And so it has a pretty pronounced spring peak as we get ready for Memorial Day and grilling. Tenderloin, on the other hand, is almost entirely a restaurant item. Most people don't try to cook it at home. There's one right way and about 1,000 ways to screw up an expensive tenderloin if you do it yourself. So most people just let somebody else do it. Extremely high last year. Those peaks last year in tenderloin were well above anything we saw during the pandemic, the early stages of the pandemic. Tremendously strong market. Ribeyes, same thing. The peaks last year were above pandemic levels, or at least equal to the spike that we got when the Packers all shut down in 2020. There's your lean market. That's what's driving the cow prices. So we went from $210 a pound to $275 a pound, $280 a pound. And it's just stayed there. Here's the other half of, well, it's the other 1/6 of ground beef market is the 50% trimmings. Right, so use.
What did it?
What's that?
What did that?
On the ground beef market? Or this one?
That one.
Well, obviously the two are kind of hooked together, because if you need ground beef, you're going to use 1 pound of this and about 6 pounds of that other stuff, roughly, if you do the math, to make ground beef. So they're kind of hooked together, but this one is a little more variable. Of course, this stuff comes off our fed cow, right? So this is what you get from the trimmings off of fed steers and heifers. This is all cow beef and bull beef, mostly cow beef. Okay, and because of this, that's what drives most of the export or the import demand for beef in the U.S., the bulk of it. This thing is kind of the basis. We start with whatever we're doing with fed cattle, we get trimmings, and then we're going to try to turn it into ground beef by matching it with enough lean beef. But the market's been strong. You know, again, compared to a year ago, we're, you know, well above where we were this time last year. Okay, that's that. Any questions? I'm going to skip over. I've been collecting a bunch of stuff, and some of this I'm not going to spend any time on, but I'll do it quickly. There's a couple of things I do want to show you that I think are kind of interesting. That's Feedlot Inventories monthly for the last several years. And you can see the seasonality, which we sometimes forget. We always do. That's why we do year-over-year comparisons to the same month. Okay, because it's going to change through the year, but we want to know how does it change in July compared to last July versus February and last February. I thought this peak last year was going to be the cyclical peak. We're already above it. Again, we're turning fewer cattle into bigger feedlot inventories. That's a moving average, which shows that it did peak last year. This is actually a shorter time frame. This one, I don't know that we'll exceed that. So if you average out the 12 months of the year and take out that seasonality, the biggest 12-month average we had was last June, May and June. But it's kind of tipped back up a little bit. We're going to push it a little bit higher. I don't think we'll go above last year's level, but I'm going to be careful because there's plenty of humility in my job without me stepping out too far on some of this stuff. But the point is, we've just continued to do that. And I showed you earlier, here's a long-term chart. The red line is cattle numbers over time, all cattle and calves. This goes all the way back to the early 70s. So from the peak of 132 million head of cattle in the country, we have now about 91 million head of cattle in the country. Look at what feedlot inventories have done, the blue line. For a long time, we have increased feedlot numbers relative to the number of cattle in the country. If you divide those two numbers by each other, you get this percentage. So feedlot inventory as a percent of all cattle and calves, it's at a record level this year. 16% of all the cattle in the country were in the feedlots on January 1. It's never been higher than that. You can measure it several different ways. As a percent of calf crop, it's at a record level. As a percent of the feeder supply, it's at a record level. This is why I keep being wrong about feedlots, because I keep thinking they can't keep doing this, and they keep doing it. If you look at fed slaughter divided by the cattle on feed, that's gone down over time, which starts to tell you how we're doing this. How are we managing to make fewer cattle into bigger feedlot inventories? And the only way you can do that is to slow down the turnover rate in feedlots. Right? You can't turn them over as fast. And some of that comes from placing lightweight cattle. They stay on feed a long time. That helps keep the feedlot full and the feed mill running. And so we've done that. I'm going to show you, though, that's kind of interesting. So, you know, that implies days on feed have gone up, and they certainly have. Okay. Now, they did moderate a little bit last year. That might be high feed prices giving us a little bit of discipline there. But in general, we've gone up. So cattle on average spend more time in feedlots. We've gone from 150 days to 180 days, another month. Cattle are bigger, so we can feed them longer. We got more stuff to help them get bigger. Implants, ionophores, beta agonists, all kinds of things that help them get bigger without getting just grossly overfed. We can still overfeed them, but it happens 150 or 200 pounds later than it used to. Okay, and so those are all factors that play into that. USDA publishes once a year an estimate of feedlot capacity, and it's actually gone up over time. We've added about 1 million head of feedlot capacity in the last 20 years. I'm not sure whose business plan looks out there and says, gee, the cattle industry's been getting smaller for 50, 60 years now, we should build more feedlots. But we're doing it somehow. So marketings as a percent of capacity is a challenge. I'm not going to spend time on those. Cattle on feed as a percent of steer and heifer slaughter, we've already. Here's one that I think you'll find interesting. I looked at it this way first, then I got a couple that follow up on that, and then I'll be done. The blue bars are the distribution of placement weights, 5-year average in the late 90s. So 20 years ago, 25 years ago. So what do you see there? Well, that kind of as expected, from 700 to 800 pounds was the biggest percentage of the total, 35%, 600 to 700 pounds, fewer big cattle, and pretty sizable number of cattle under 600 pounds. The red bars are the 5 years from 2016 to 2021. The number of lightweight cattle has not changed a lot. It's gone down just fractionally. The number of 6 to 7 weights and 7 to 8 weights have gone down sharply, and the number of cattle over 800 pounds has gone up. So what we're doing now is feeding two kinds of cattle in the feedlots. We're placing them either really big or really small, and we're using that to sort of average out over time. The really small ones, partly because we have to, but partly because that gives us more days on feed and ways to keep the feedlot full. The big cattle is what we really like to feed because they have less health problems, they gain better, et cetera, et cetera. Okay. And all of that, of course, has to happen within the context of where you are with cattle numbers and what's going on with the cycle and so on. But in general, that's happened. So having done that, I've dug a little deeper and put it together over time. And sure enough, the green line is 600 to 800 pounds. So I put the 6 and 7 weights together. As a percent of total placements, the 600 to 800 pounders have gone from 58% down to about 42%. The red line is the over 800 pounders, which have gone up from, and this is going back to what, 97? From less than 25% up to over 35% now. And the lightweight cattle just haven't really changed very much. Now, I'm not sure what all this means. I just did these actually about a week ago. I'm still playing with this stuff, trying to figure out what it means. But I suspicion that there might be more to this story. So the black line is if you calculate average placement weights over time across all placements. So that's the black line, and it's gone up a little bit. So it's gone up about 20 pounds over the last 20 years, 20-ish years. Okay. But if you look at the two biggest cattle feeding states, Texas and Nebraska, the red line is Texas. Yeah, there's been some variation, but on average, and I calculated the average over the thing from front to back, the average placement weight in Texas hasn't changed. Okay. Now the cattle are smaller down there, and you would expect that, I think. Okay. Southern cattle are just smaller than northern cattle. But in Nebraska, not only are they bigger, always, they've gone up more. They've gone up about 40 pounds in the last 20 years. If nothing else, what this highlights is just how diverse this industry is. And in all of the crap we've had about, and I shouldn't say that way, but I will. And all of the discussions we've had the last couple of years about pricing cattle and all that stuff and all of that, and a lot of that is northern versus southern. And what this really illustrates is the fact that we call it one cattle industry, but regionally it's a very different industry in every sense of the word. And this really highlights that. I think that's most of what I have. This just goes through all of the placement weights and kind of shows you what they do through the year. So lightweight cattle, of course, we place more of them in the fall. Not surprisingly, this is under 6 to 7s, same tendency. We're still getting basically the calf placements. After, we get to 7 to 8 weights, now we tend to be tipped a few months later. 8 to 9s, again, it's kind of, the weight of cattle pulsing through the system. So the ones that we didn't place last fall as calves, we background them, we winter them on wheat, whatever, and they come in March, April, and May. The really big placements, over 900 pounds, happen in the end of the summer. Those are season-long yearlings coming out of various long yearling programs. So what that says is if you put them all together, the composition of feedlot inventories is very different at different times of the year. And I think that's something we overlook a lot of times. When you try to figure out what feedlots are doing, when I try to figure out what feedlots are doing, it's really difficult because they're dealing with different sets of cattle at different points in time in terms of what they've got on feed. And so all of their parameters are being impacted by that. All right, I'm done. And we still got a couple minutes. You guys are awfully quiet, almost scary quiet. I don't know what that means. Questions, comments?
You talked about the number of cattle in the feedlot continues to increase. Are those increases in feedlot numbers new feedlots, or are they just expanding the feedlots?
The short answer is I don't know for sure, but I'm going to say in most cases it's probably expansion. I don't think we've built brand new feedlots very much. But the ones that are out there, put another set on the backside, and look what Bill Rocher's done up here. That's just a good example. Over the last 20 years, he's darn near doubled, I think, in the last 20 years. And that's a good example of the kind of thing that happens. So I think that's most of it.
So if these feedlot lots run, short on cattle, where are they going to come from? Where are we going to bring them in from?
Well, obviously the imported cattle play into that a bit too, but they're kind of built into these placements. Everything we've been looking at isn't distinguishing that. So, and there's limits on that as well. So I don't think you're going to make up for declining numbers. At some point in time, they just won't have the cattle. The numbers will go down relative to capacity. And then the feedlots are going to be even more unhappy because they got overhead like everybody. Like I said, they're, feedlot manager told me once, a feedlot's just bed and breakfast, and you make money selling breakfast. So they try to keep it full so they can keep the feed mill humming, and that's the business. That's what it's all about. And they will do that as long as possible. That's why they're doing what they're doing. And you know, you can look at that and say, you guys might be better off to slow down a little on placements now, let those cattle get a little bit bigger. They might work into your economics with the cost of feed a little bit better. And their answer is going to be, hey, I've been making some money. I got money in the bank. I'm going to go get what cattle are there until there just aren't any. You know, and I'm not really slamming them, but their perspective is week to week or month to month at most. Because they're all drinking from a fire hose. So they're just thinking about this week and next week. And so they're going to keep doing that.
We're no different.
No, I think we all are that way in one way or another. I think you're absolutely right. I mean, everybody is that way, right? And so, and you know, if you had one giant feedlot czar, maybe you could do that. But when it's individually, then if I don't buy them, somebody else is going to buy them. So I'm going to go get them, right? And, you know, the milkshake's dropping, but as long as I got a straw, I'm going to get all I can before the sucker runs dry. And I think that's kind of what's happening. So, yeah, it just means that, you know, they face some, I mean, to that end, you can think about someday feeling sorry for feedlots if you don't now. They're going to have fewer cattle and really high cost of gain in the second half of the year. It's going to get pretty tough. Right now, they're actually making some money. And, you know, futures, well, that was the other thing I was going to say about the future stuff. So we looked at those 180 August feeders. And if you use that, you can price in something that makes a margin relative to the price of 5 weights today. That all sort of works. However, if you take that 800-pound steer in August, in Oklahoma would be maybe $1.50 less with basis. So call it a 179 steer. So just for fun, I ran that through a feedlot budget. That 800-pound steer in August comes out mid-January next year.
He's going to have to bring like 165.
And that's depending on what cost of gain you put in there. You get a break even of 162 to 165. February live cattle futures are at 152.
$13 off.
So they're you know, $10 to $13 out of the money. And that's why I wrote in my newsletter this week, this sucker is not in balance. Something's going to change going forward. And I don't know what. But, you know, now they don't ever line up perfectly. And you know, and margins don't ever usually hand you anything. It's not for very long. But when they're this far out of whack, you know something's going to give. So, you know, could the fed cattle be 162 by next spring? Yeah, they certainly could. I can make that scenario. Am I willing to bet a whole lot on it? Probably not a lot at this point. I don't know. I don't know how this thing plays out. I just know we've got a lot of stuff priced into those futures and really more in the feeders than anywhere else at this point, which maybe says you need to take advantage of that. Even calves, a 5-weight steer on that, I use November or October, I don't remember, October feeder. You could buy an expensive October put and set a minimum price for 450-pound calves at 207 or 20 something like that, 206, 207. A minimum price using a put. If the thing goes higher, great. How many times does a cow-calf guy get to lock in $2+ a pound for calves in the fall this early in the year? I don't think it's happened before that I can remember. So, you know, maybe there's some opportunities there we ought to be taking advantage of. I'd minimum price stuff though, because this sucker has the potential to take off too. I mean, it could go. And tell me what the drought's going to do the next 5 months, and that'll have a lot to do with what it might do both this year and next year, maybe even the year beyond.
Well, you know, are you aware that
I hate it when he starts a sentence that way.
on a lot of these heavy bred cull cows, which normally some guy would buy and calve out, there's some of the packers were buying them just for the fetal blood.
Oh, yeah.
Is that also
that would be reflected in general in those coal price. I mean, it's all part of that thing. I mean, you know, that market's, it's always there. Maybe I don't know I haven't checked into it. It may be higher than usual, but it's always there.
It's really high.
Despite that, they usually won't chase bred cows to get that. But if they happen to get one, they certainly will take advantage of it. They may actually be okay with them. So you're saying basically they don't care right now if they're.
Well, yeah, there's a couple buyers that will buy those heavy bred cow cows for a premium.
Yeah. Yeah, I don't doubt it.
Well, there's,
you know, and I mean, they may get a chance to do even more of it here in the next few months if the drought continues to get worse. On the other hand, sometime, if not this year, next year, it'll go the other way, and they won't be able to get them because there's going to be a big demand for those things to rebuild the herd. I don't know when that happens at this point. It doesn't happen this year in terms of the cow side. We could start saving heifers by the end of the year. That's what would make that feeder supply get really tight late in the year. We have to kind of start over again. That 3% decrease in replacement heifers. Replacement heifers is two parts. It's coming first calf heifers that are going to calve, and it's heifer calves that we save to breed, but they're not bred yet, right? And so that category of replacement heifers is two different calf crops of heifers. And, you know, we kind of know how many of them are bred and they're going to calve this year, and there's not very many of those calves out there. So just not a lot we can do this year, but we could save a whole bunch of calves potentially by this fall to get ready for next year and beyond, if the conditions are right. Okay, I'm not sure that we will, but that would be about the soonest it could happen, would be that we start trying to hold a bunch of those heifers this fall. I don't know, lots of dynamics. I know I've said this before because we have been through an awful lot the last 3 or 4 years, but I'm not sure I can remember a list of things to talk about. So much so that my colleagues and I, we're all part of the Livestock Marketing Information Center, right? My counterparts around the country and so on. We have scheduled a conference call in a week or so just to collectively talk through all this stuff, because none of us can keep all this crap in our mind at one time. There's just so many things. And so we don't do this all the time. We do share information, but more indirectly. We're actually going to have a conference call and just kind of go down this really long list of stuff and try to sort it out in our minds. And that just kind of tells you how much stuff is out there. I don't envy you, because you guys actually have to make decisions on it. I'm just trying to help you.
Back in 2009, kind of, it was a start on a drought out in Texas. More this way too. How does that shape up? And then about that same time too, I think we were looking at desert storms, which of course is American involvement.
Right.
How does that look at compared to what's going on now, especially with Ukraine?
Right. You know, there's never a perfect analog, but you look for those. In terms of the overall drought situation, yeah, in terms of the overall drought potential, I mean, 2011, 2012, which you're talking about going into that, is the closest thing. The main difference, as I said, with them was the drought was very intense in a really big cattle area, Texas and Oklahoma, but it wasn't in other parts of the country. This one's much more widespread. So there's some differences, but the overall potential level of impacts is roughly similar. We were in a recession then. We very likely may go into some sort of a recession here coming up. Okay, now we have high inflation right now that we didn't have then, so that's a difference. So there's some things that are similar, there's some things that are different, but yeah, we're looking at kind of, you know, what sort of, and of course we have no analog for a military, a world with a war that could get more world involved. I mean, we got nothing since World War II. And even I wasn't around to look at markets back then. So I don't know what happened. I know my dad had tires were so tight that he had to take a tire off a tractor and put it on the car to drive to town for a physical that he was required to be at. I think he went through 4 physicals and they never could make him healthy enough to send him off. So he stayed on the farm, but they kept sending him One time he had to bus all the way to El Paso from West Texas for a physical, and then they sent him home and said, go back to farming. But anyway, that's a story I remember from my childhood. Was that he had to take a tire off the tractor, front tire, and put it on the car or pickup, whatever it was, to get to town. That was the only tire we had.
Get tractor tires.
So, you know, we aren't quite in that shape. I guess that maybe that's the other lesson here, right? What's that?
They got tractor tires, but not car tires.
Well, I think, I don't know. I'm guessing he was using a car type tire on the front of a tractor, which I've seen before because that was all they had available for the tractor.
Yeah.
And he was using the tractor every day and he wasn't using the car every day.
Yeah.
I really think that's what I've always assumed. I didn't ask him about. I don't think it was actually a bona fide tractor tire on the car. Could have been.
Get car tires back then.
And, but I've seen them before, even in my experience, when people would use just a regular car type tire or light truck type tire on the front of a tractor. Not because it was smart, but because it was what you did. Anyway, it's 10 after 8, guys. I guess I better go to El Reno and see what prices are doing today.
You let him ride with you, Stanbridge?
I don't know if you're going or not today. Probably. Well, I'm actually closer here than I am when I leave from home, so I'm still in pretty good shape. I'm going to get there as soon as I ever do. So we're in good shape. Thanks, guys. Appreciate it.
Hey guys,
Let me know if we can do something.
Yeah. Letters went out. If you haven't heard, I know most of you know, but banquet for County Cattlemen's April 15th, Friday before Fairgrounds. We are going to vote on becoming a unified county with OCA. We're bringing the membership, the board's cleared it. We are bringing that be for a vote. With the letter is also membership renewal / application. $50 for the household, gives you the whole household a meal at the banquet. You can either mail those into the extension office, or you can pay at the banquet at the door. So, just so everybody knows.
Derrell, appreciate it.
You bet, Don. Good to see you.
Yep.
Yep, no problem. As soon as I get a chance, I will.
The other thing is,
You want me back in?
red old cows.
Maybe, yeah.
I haven't looked at the coat count as far as that part goes, but I don't doubt it. Like I said, I don't. I mean, that's not something I regularly see. Yeah, I mean, you know, like I said, that's always there. It may be hotter than usual right now. I don't know. I'll ask around and see if I can find out if there's something. Those are not prices that generally get reported. So you just kind of got to ask somebody that knows, but I can probably find out. I had not heard that, but I'm not terribly surprised either.
Thing I see on that, knocking out a whole calf crop too.
Yeah,
Those cows would generally be calved out by somebody.
most of the time.
And then those cows come back to open cull cows later in the year. So not only did you take those cull cows out, you took those calf crops.
That's what I was
Yeah.
saying,
Yeah, to the extent that
tighten the numbers up. even
which,
more.
yeah, to the extent that it's happening, that's absolutely right. I mean, I don't think, you know, right now, given conditions and stuff, that they're overly strong red cow market. So those cows, I mean, seasonally, it's going to be higher right now. And with the cull cow market underneath it, that helps support it, at least at some minimum level. Those two are different markets, but they're kind of like corn and wheat, right? Corn is always going to be a base for wheat. Although there was a few months last year where that market was inverted as much as I've ever seen.
Yeah, but it was speaking of the week back there.
There was. It didn't last very long, but the magnitude of difference, there was times in there last year when it was $1 cheaper, $1 a bushel cheaper than that. Didn't last very long, but they did. And obviously they do feed wheat when that happens.
Dad and Grandpa told me they couldn't get car tires during the war because of the war. They could get tractor tires.
And maybe that's what it was. I've never asked. I'll have to ask my brother. He's a lot older. He'd remember for sure.
Grandpa said those tractor tires wouldn't last on the farm.
I'm sure they wouldn't. And that might have been, I've always just assumed that it was a car tire that was on the tractor, but it might not have been. It might have literally been the tractor
They
tire.
couldn't buy a car tire because of
Well,
the war.
yeah, right,
I mean, it was
no.
like sugar, it was rationed.
Yeah, they were rationed. And that's why tires were tight in general, but so maybe it was literally a tractor tire. I don't know.
Well, I know they talked, Grandpa talked about putting a car.
A tractor tire on the car.
On the car, on the front.
I bet that's a smooth ride.
Oh, yeah.
Man, don't you think? Woo! God, can't imagine.
Well, the pre-red tractor tires.
I gotta go.
Well, yeah, they roll with cars. I bet they don't give like a regular car.
Yeah, maybe.
Especially if you only got them on one side.
No, I think they put a pair on.
They put a pair on. I always had the impression he's put one on, whatever it was, they only put one on.
Oh, really?
And I might be wrong on that.